Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
All right, let's dive into the tech world. We have 5 major stories for you today. First up, how chipmaker Nvidia dethroned Apple to become the most valuable company on the planet. Then we'll look at Microsoft's brutal strategy of laying off thousands to fund an AI empire it might not even win. After that, we'll cover the public clash between OpenAI and Robinhood over the sale of its tokenized shares. We'll also examine Apple's calculated rebound in China and how a resurgent Huawei is still outpacing it. And finally, we'll wrap up with the US. Government's stunning reversal on tech restrictions against China in the global chip war. A single company is now worth more than the entire stock markets of Canada and Mexico combined. That company is Nvidia. In a stunning power shift, the chipmaker has officially become the most valuable company in history, with its market capitalization soaring to a jaw-dropping $3.92 trillion. It just unseated Apple, the long-reigning king, to take the crown. The reason? An insatiable global arms race for artificial intelligence. Giants like Microsoft, Amazon, and Meta are in a mad dash to build out their AI infrastructure, and they all need the one thing Nvidia makes better than anyone: high-end AI processors. As one analyst put it, there's this huge rush with AI spending and everybody's chasing it right now. Just to give you a sense of the scale here, just 4 years ago, Nvidia was worth around $500 billion. Today, its value is multiplied nearly 8 times. This is a company that started by making chips for video games and has now become the foundational hardware for the entire AI revolution. This isn't just a number on a screen, it's a fundamental reordering of the tech world. Nvidia's rise has been so meteoric that it recently took the spot on the Dow Jones Industrial Average that was once held by chip-making legend Intel, signaling a dramatic changing of the guard. So you have this incredible concentration of value and power in a single company, one that's basically providing the shovels for the entire AI gold rush. It leaves us with a critical question for the future of tech. What happens when one company holds all the cards? Speaking of the AI gold rush, Nvidia might be providing the shovels, but companies like Microsoft are spending fortunes to dig, and their strategy is, well, brutal. Microsoft is pouring a staggering $80 billion into its artificial intelligence empire. The price tag for that? 9,000 jobs. This isn't just a quiet restructuring, it's a bloodbath, and the company's legendary Xbox gaming division is right in the crosshairs. Entire projects are being wiped off the map. The highly anticipated reboot of the classic shooter Perfect Dark cancelled. The studio behind it, The Initiative, shut down, and it gets worse. Layoffs are hitting the makers of Forza Motorsport and The Elder Scrolls Online, with one studio director announcing his departure after nearly 2 decades. This is where the situation takes a more complex turn. While Microsoft is showing thousands of employees the door, a frantic, high-stakes talent war for AI experts is exploding across Silicon Valley. Rival companies like Meta are reportedly poaching top talent with signing bonuses of over $100 million. It all comes down to a brutal calculation. As one Microsoft exec put it, the next 50 years will be fundamentally defined by artificial intelligence. So, their play is clear: sacrifice the present for a dominant AI future. But that's not the whole picture. The real twist is what's happening with their own AI products. Despite being a major investor in OpenAI, Microsoft is reportedly struggling to sell its own AI assistant, Copilot. Apparently, business customers just prefer using ChatGPT. So, Microsoft is gutting its successful divisions and laying off thousands, all to chase this AI dream. But what if they're betting on a future they can't even win? And speaking of OpenAI, the company at the center of Microsoft's big bet is now making headlines for a very different reason: a public feud with Robinhood. The AI giant went on X, Twitter, and dropped a statement that reads like a corporate cease and desist letter. The drama all started when Robinhood announced it was offering tokenized shares of private companies like OpenAI and SpaceX to its users in Europe. The stated goal was to democratize access and let anyone participate in the economy of these high-flying tech giants. But OpenAI immediately shut that down. In a blistering post, the company stated, "These OpenAI tokens are not OpenAI equity. We did not partner with Robinhood, were not involved in this, and do not endorse it." They even followed up with a stark warning to the public: please be careful. Now, here's the most ironic part. The day Robinhood announced the controversial token sand got publicly disavowed, its stock didn't tank. It surged to a new all-time high. So, what's actually going on here? Robinhood claims these tokens aren't direct shares, but instead give investors indirect exposure through a special purpose vehicle. It's a complex financial workaround really designed to give European retail investors a taste of the private markets. But OpenAI's stance is crystal clear. The company says any transfer of its equity requires its direct approval and flatly stated, we did not approve any transfer. This isn't just some corporate squabble. It's a high-stakes clash over the future of finance, pitting the crypto world's tokenize everything philosophy against the world's most valuable private companies fiercely protecting their name. This really brings a fundamental conflict to the forefront. Who ultimately gets to control a company's value? The company that built it, or anyone with the technology to put its name on a token? From a clash over digital assets, let's turn to a battle for market dominance on the ground. After a brutal 2-year slump in its most critical market, Apple just did something many thought was impossible. Its iPhone sales in China are growing again. For the first time since 2023, iPhone sales shot up 8% year on year. Now, this turnaround wasn't an accident. It was a calculated strike, with Apple launching major discounts on its latest iPhone 16 models and increasing trade-in prices right before China's massive 618 shopping festival. One analyst called the timing well-timed and well-received. But this comeback story has a major plot twist. It's happening in the shadow of a resurrected giant, Huawei. After being crippled by US sanctions, Huawei made a stunning return with a new advanced chip, aggressively launching devices and eating away at Apple's market share. And what really puts Apple's comeback into perspective is this. While Apple celebrated its 8% growth, Huawei's sales in the same period surged an even higher 12%. This battle for China is a high-stakes drama playing out amidst geopolitical tensions, including threats from the US president to slap tariffs on Apple products not made in America. So, who's really winning? Despite Apple's celebrated rebound, it's not the top player in China. Not even close. The latest data shows Huawei is now number 1 in market share, with Apple in 3rd place. It really makes you wonder, was this a brilliant comeback for Apple or just a temporary boost from a price cut in a war for dominance it might actually be losing? That battle in China is playing out against the backdrop of a much larger geopolitical chess match. And in a stunning reversal, the US government has just made a move that changes the entire game in the global chip war. This isn't a minor tweak, it's a bombshell announcement that sent shockwaves through the industry. Just weeks ago, on May 23rd, Washington told America's top chip design software companies they needed a license to sell to China. Now, that order has been completely rescinded. The companies at the center of this are the titans of the industry: Synopsys, Cadence, and the US-based subsidiary of Siemens. And to understand just how powerful these companies are, consider this. According to TrendForce, these 3 firms collectively control a staggering 74% of the entire global market for the software used to design microchips. It's a near total dominance. The previous restrictions were clearly causing pain. The CEO of Synopsys, Sachin Ghazi, admitted on a recent conference call that the company saw a slowdown in China, a market that makes up about 10% of its massive $1.6 billion in quarterly revenue. What really brought this to a head, though, was the timing. This reversal comes right after China signaled it was making progress on a broader trade truce, including resuming some exchanges of rare earths and advanced technology. It also comes as China is aggressively funding its own domestic chip design software makers, trying to break free from its reliance on the West. With the restrictions lifted, Siemens says it has already restored full access for its Chinese customers, and Synopsys and Cadence are rushing to do the same. Their stocks, predictably, jumped on the news. So in the high-stakes chess match of the US-China tech war, you have to ask, is this a genuine truce, or is it a calculated retreat to let American giants reclaim their market share before it's too late?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.